Hey y'all, it's Austin at Homeowners Financial. And one of the questions that we've been getting a lot lately is how do bridge loans work? Well, there's a couple different products out there. So I'm going to go over one that is a pure equity based bridge loan. Now, look, there's bridge loans products that give you a second mortgage and buy a new property and you qualify only on the second property. There's bridge loans products where you qualify on both property. This one is again pure equity based. So they're looking only at the equity in the two properties. Yes, they are running your credit report. They got to make sure you meet certain guidelines for payment history, certain credit score requirements. No, they are not necessarily looking at what your other debt obligations are per se. They are indeed looking at what funds we have available for closing, because as you're going to see in the calculator I'm going to share, that you do need to come with some sort of skin in the game, so to speak. It's not going to be a zero to you. And then they also want to verify that if you do need a loan in the end, that there is the ability to repay, and that's where we do this. So it is based on a lot of different verifications, but the pure qualification side is truly on a bridge. So I am going to share my screen, all the shares. All right, so for example, let's say that we have a client that wants to buy a new $1.5 million property. And let's say their current property is worth 1.2. All right. Now let's say that they owe $350,000 on that current property. Now, the way that this would work is it actually be a cross collateralized lien. So it's going to have that second position lien behind that 350 and a first position lien on the new property. So it's one lien that covers both. That's why it's considered a bridge, right? Because it's bridging the gaps and typically they anchor against both. Now, this product is really unique again because it can go up to 70% loan to value. In this scenario here, there's plenty of equity between the two properties to get enough to buy the new one. So what they're bringing in, the clients are bringing in are the origination fee and what their standard lender fees are, right? That's your underwriting, that's your doc prep. You do have appraisal fees on top of this. You do have title insurance fees on top of this. And a lot of those are going to be dependent on how unique your property is, how quickly things need to get done on the appraisal side, and what you negotiated in the contract for the title and escrow side. Now, you see that there's a 6-month and 11-month term option, and you also see that the interest rate is 9.95. So in this scenario, a client would be making monthly payments of $12,437.50 each month until their property sells. You would have either 6 months or 11 months to do so. And you see the difference is not in the interest rate here, but in the points. What if you didn't want to make a payment each month? Well, you could defer for a 0.25% higher in interest rate, which would move it here. And you'd be at 10.2 in this sort of scenario. And now you're deferring, which means you're tacking it on to the end, that $12,750, again, for either a 6-month period or 11-month period, what we decide really as you get into escrow. The really cool thing about the deferment or any of these bridge loan options is that you only pay on what you use. So if you wind up selling your property in 30 days, cool, it's 1 month. It doesn't mean that you're necessarily paying the full 6 or 11 months of time frame. So that's a really great creative bridge loan option. We are still able to close these in 30 days. I want to make sure you have all the understandings if this makes sense for you and your financial decision. It's outside Homeowners Financial. Let me know what I can do to help you or anyone else. And I'll talk to you soon. Bye.